Please, let's start. So go to foreign exchange rates and their determination. So when we talk about exchange rates, we're talking about the prices of a country's currency with respect to other countries' currency. That is what exchange rate is, the price of the dollar against the dinars. But here we're going to talk about the price of the dinars because we are in Libya against dollars or pounds or the rest. I think that is clear, right?
Yeah.
All right, let's go down. So here they say, what is an exchange rate? Exchange rates are needed because different countries use different currencies. So we need exchange rates because each country has their own currency. So that means we cannot use we don't have common currencies. So that means we have to exchange currency. That's why we have exchange rates. Okay. When trading with other countries, payments must usually be made in another currency. In getting started, we learned about €1 to the Japanese yen of 120. This is an exchange rate between the euro and the yen. It shows the price of euros in terms of yen. Similarly, let's forget about the stories here. Let's just go down. Yeah, factors affecting the demand for a currency. So there are two things about currency. There's demand for and the supply of the currency. So these are the reasons why we have high exchange rate or low exchange rate. So if the demand for a currency increases, the price of that currency would rise. If the demand for a currency falls, the price of that currency would fall. Do you get the point I'm making here?
Yeah.
If other countries need more of our dinars, then the dinars will rise against other currencies.
Yeah.
And if our currency is not needed in the market, then the price of our currency, that means the dinars, would fall. So what are the factors? The first one, let's say the demand for a particular currency on foreign exchange markets is affected by a number of factors. One, the interest rate. What is interest rate? Interest rate is the price of borrowing or saving, right? So here they said interest rate can affect the flows of money around the world. For example, if interest rates are higher in the UK than in other countries, foreign savers may choose to put their savings in a UK bank. However, before doing this, they will have to buy pounds with their domestic currency. This is because they can only deposit pounds in UK banks. Therefore, an increase in interest rate will increase the demand for pounds and cause the exchange rate to rise. A fall in the UK interest rate would have the opposite effect. So now we're going to use, instead of using UK as a case study, we use Libya as a case study. If the interest rate in Libya increases, that means the price of saving and borrowing increases in Libya.
Yes.
Yeah. So what is the consequence? The consequence is that a lot of people that want to save, that wants to enjoy that high interest rate will start saving. They will come from other countries to save in Libya.
Yeah.
So when they come to Libya, they're not going to save the naira, the pounds, the dollars. They're going to have to save the Libyan currency, which is the dinars. So what happens? They need to buy more of dinars to be able to save in the Libyan bank. You won't save pounds in the Libyan bank. You won't save dollars in the Libyan bank. Though there are always what we call domiciliary accounts. These are accounts for foreign currencies.
Yeah.
Do you get me? But here we are talking about saving in the current account. So that means you want to save in the current account for you to be able to enjoy this interest rate. It's not the same like you saving your normal dollars or pounds in your domiciliary account. Here you want to save in a fixed deposit that's going to be there for like a year or more. These guys get what I'm saying?
Yes.
You as a British person, you want to save in Libya now. You won't save the pounds. You will save the dinars. Then how are you going to be able to get these dinars? You need to buy more of dinars. So as a result of an increase in the interest rate in Libya, the demand for dinars would increase. This will make the prices of dinars to rise against pounds, against dollars, because all pounds will come to Libya for the exchange of dinars. All dollars will come to Libya for the exchange of dinars. So the demand for dinars has increased as a result of high interest rates. Do you get the point here? So that is how interest rate is being linked to exchange rate. On the other way around, if the dinars fall, if the interest rate falls in the economy, if the interest rate in Libya falls, a lot of people would not save. Rather, they want to continue to buy.
Yeah.
Do you get it? So the value of dinars would fall. because nobody is going to be willing to save. Do you understand interest rate here? Is it clear, please? Then we go to currency speculators. Who are speculators? Speculation means predicting what could happen in the future. You don't know maybe there's going to be rise or fall. That's speculation. You don't know. So you are taking a decision about possible situation about what could happen in the future. Because you want to, so you want to try to save money, or you want to try to act in the market for making profit that is unforeseen, based on speculation, based on information from here and there. Oh, they said. So you base your action, you base your investment on information that might not be true.
Not facts.
Not facts. So here they said speculators are firms, individuals or financial institutions that buy and sell currencies in the hope of making capital gain. That means they want to make profit. So you are making investment right now because you are hoping that in the future, prices of whatever you bought now is going to increase in the future. These are who speculators are. They make investment now, hoping that in the future they're going to make capital gain, which is profit. That's another reason why the demand or why the exchange rate might rise. So if we have in our mind as speculators that the dinars will fall in the future, we want to buy more of dinars now.
Yeah.
So the price of dinars will rise now because there's the speculation in the market. The speculation makes us to feel that in the future the price of dinars would fall. So we want to sell now. We don't want to buy anymore. We want to sell right now.
Before the price falls.
Before the price falls, so that we can make profit as soon as possible. But if in the future we feel that the price of dinars is going to increase in the future, we want to buy more now, so that we can enjoy selling it in the future. Do you get the point? If we think now, or the speculation that the value of the dinars is going to fall right now, so what do? We buy, no, it's going to fall in the future. What do? We try to buy more dinars now, so that we can sell. We try to sell the dinars we have now, so that we don't lose out in the future.
Yeah.
But if the price is speculated that it's going to increase in the future, we buy more now, so that we can enjoy the benefit in the future. That's about speculation. Is it clear?
Yes.
The third point, the demand for export. Export is you selling to foreign customers, right? Export is you selling to foreign customers. Yeah. Yes or no?
Yeah.
So if the demand for foreign goods increases in the country, that means your currency will be needed more. Yes or no? So if Libya is doing more exports, it means more of dinars will be needed in the market. Yeah. So that will increase the price of the dinars against other currencies because of exportation. Do we get the point here? Yes. An increase in the export of a country would definitely increase the price of its exchange rate, would increase the value of the country's exchange rate.
Yeah.
All right. So we're talking about the demand for exports. Export means you are selling to foreign countries. You are selling to foreign countries or foreign customers or foreign businesses. If you are selling to foreign countries, they need more of your currency. So that means the demand for your currency will rise. As a result, the exchange rate, the value of your currency would increase. That's about the demand for exports. Is it clear?
Yeah.
Well, let me see if okay, here they said, firms that sell goods and services to foreigners expect to be paid in their own currency. For example, firms in the UK, let's see, that's just it. There's nothing there. So movement of investment capital, the last paragraph here. Movement of investment capital can also affect the demand for a currency. For example, if a foreign multinational wants to build a factory in the UK, it will need the pounds to pay for the materials, labor, and other resources required for the construction. An increase in inward FDI, that's foreign direct investment, will increase the demand for pounds, and along with it, the exchange rate. A decrease in inward FDI will have the opposite effect. So, if multinationals are coming into this country, if multinationals are setting up in Libya, they will need to pay their workers, they will need to pay for raw materials, they will need to pay for whatever they have to pay for with the Libyan dinars. As a result, the exchange rate will rise. Because the demand for your currency is increasing. And when the demand for your currency increases, the exchange rate would rise.
Yeah.
Is it clear?
Yes. So exchange rate depends on the demand of
demand for and the supply of. Demand for your currency and the supply of your currency determines the exchange rate. So if the dinar is more needed, the value for the dinar would rise, would appreciate.
What about the supply?
Now we talk about supply. So now factors affecting the supply of the currency. The factors that affect the supply of a currency on foreign exchange markets are similar to those that affect the demand, interest rates in other countries. If interest rates are higher in other countries, savers in the UK may decide to place their money in foreign banks. To do this, they must buy foreign currency. This will increase the flow of pounds into the foreign exchange market, which will increase supply and reduce the exchange rate. The opposite will happen if overseas interest rates are lower than the UK. So now, as Libyans, the exchange rate in Libya is falling, it's going down, but in the UK, the exchange rate is increasing. So that means we need to start thinking of saving our money in UK. Yes or no?
Yeah.
So our money has to flow out of UK, our money has to flow out of this country to buy more of the pounds, isn't it?
Yeah.
So that means we need more of the pounds now to be able to save in the UK. So this will reduce the value of our exchange rate. Do you get the point here? So now we need more of pounds. So supply of pounds will be needed from the UK. Do you get it now? So we need more pounds. That means UK must supply us with pounds. So this is what we're talking about, the supply here.
Yeah.
Do you get it? The other time, the British people need our dinars. So the demand for dinars is increasing. Now, the supply of pounds must increase because we need to start saving in the UK. We demanded, but we're not going to use demand anymore.
Yeah.
So the UK has to supply us with pounds so that we will not be able to save in the UK. So an increase in the supply, that means the supply of the exchange rate, the supply of the pounds must increase because we need more of the pounds.
Yeah.
Do you get the point? All right. Currency speculators. This goes the same way. Speculators can affect both supply and demand of the currency. For example, if speculators believe that the price of the pounds is going to fall, they will sell all the pounds because they feel that the price is going to fall. So if the price falls, they become worse off. They don't want to be worse off. They want to make profit as much as possible.
Yeah.
So they will sell. They buy more if the speculation is about an increase in price in the future. They sell now, they sell more if the speculation is about a fall in the price in the future.
The same as demand.
Yeah, in demand, we talked about both together. In demand, we talked about buying and selling.
Yeah.
Selling here is for supply, buying is for demand. You buy more if you think the price is going to rise in the future. That is the only way you can make profit. You sell more if you think the price is going to fall in the future. That is how you can make profit right now. Do we get it?
Yes.
Are you here? So the demand for imports now. If we do more of imports, that means we need foreign currencies. Yes or no? So the head said imported goods and services have to be bought with foreign currencies, like I said. Therefore, if UK importers buy more foreign goods and services, they would have to buy foreign currencies with pounds. Here, we need to buy from the UK, we need to buy from Turkey, we need to buy more of their currency. Do you get it?
Okay.
So if not, we won't be able to do exchange. So what happens? The dinars will leave our country short because we need more of other country currencies. So the value of the dinars would fall. So importation is not really good for the country because when you do more imports, it also affects your balance of payment current account.
Becomes deficit.
Deficit because you do more imports. So as it's affecting your balance of payment current account, it also affects your exchange rate. Because here you need more of your currency to buy other countries' currency because of foreign consumption.
Yeah.
Do you get the point? You think more of buying foreign goods, then you need to pay more of your currency to get those goods.
Yeah.
So it devalues your own currency and appreciates other countries' currency. Is it clear? So our exchange rate is determined. So for the exchange rate, there are two ways in which we determine the exchange rate. We have the fixed exchange rate and the floating exchange rate. We're going to get there. So why do we call it floating? We call it floating because it's determined by the market forces of demand for and supply of. We call it fixed because it's determined by the central bank of that country, by the government.
Yeah.
Do you get my point here?
Yes.
There's floating exchange rate, there's fixed exchange rate. Floating is the ones we have in the black market and the parallel markets. That's the floating. It's determined by the demand for and supply of currency. But the fixed one, there's nothing you could do about it. It's determined by the central bank of that country,
Yeah.
or basically the government. So let's just go down here. They said currencies are bought and sold like commodities. Okay. They said currencies are bought and sold like commodities on the foreign exchange market. Banks and other financial institutions trade in these markets to obtain foreign currencies for their customers. The forces of supply and demand, as outlined above, determine the price of any currency. For example, if there is increasing demand for sterling, the price of the pounds will rise. The figure now shows. So look at the figure here. We have the demand for and the supply of at equilibrium 1.5. So the price at which both the market forces are determined to pay is 1.5. That's the price of the pounds against the dollars. Do you get the point?
Okay.
So if you have to buy the price of the pounds for £1 is $1.5. So that is the market equilibrium. That is the price at which both the demand for and supply of have agreed to pay for buying the pounds. Is that clear? I think the graph is understood. It's at equilibrium. That will form in front of me. I want to see it like this. I think it's clear.
Yeah.
That's about that. Demand for, supply of, that's equilibrium. So we'll go down, let's see. Change in supply. They say if there's a change in the supply or demand for a currency, there's likely to be a change in the exchange rate. The market of a currency is no different from any other market. For example, what will happen if there's an increase in the supply of pounds? If there's an increase in the supply of pounds, an increase in the supply of pounds resulting from importers buying foreign currency with pounds is shown by a shift from S1 to S2. An increase in the price of pounds, an increase in supply of pounds will shift the supply curve to rightward from S1 to S2. What would have caused that? It would have meant that we need more of pounds.
Yeah.
We foreign buyers, foreign consumers, we need more of pounds. So that will increase the supply of pounds from S1 to S2. Then what happens to the equilibrium? The exchange rate will fall from ER1 to ER2 because there's more of supply of the pounds in the market. Remember we said when the supply of a currency increases, the price, even for goods or services, when the supply increases, the quantity supplied increases, the price would fall.
Yeah.
Because it's going to be like excess in the market.
Yeah. And quantity increases.
Yeah, because the quantity is increasing from S1 to S2, the quantity has increased from Q1 to Q2. The exchange rate will fall from ER1 to ER2.
Supply.
Yes. So for demand, if the demand for UK export rises, there will be an increase in the demand for pounds. If the demand for export increases, what happens? We need more of pounds. Do you get what they're saying here?
Yeah.
This is the demand for pounds rightward from ER1 to ER2. Because the quantity demanded for pounds has increased.
Yeah.
So what happens to the price of pounds? The price of pounds will rise from ER1 to ER2. Do we get it or not?
Yeah,
An increase, and I should explain again, right?
Okay, yeah. I think I missed some.
Okay, let me just go back here. If the demand for UK export rises, now that's the point. If the demand for UK export rises, that means we need more of UK do more of exports. If UK do more of exports, what happens? The demand for UK currency would increase, yes or no?
Yes.
Shifting the demand for rightward from D1 to
D2.
D2 because export has increased. So what happens with the quantity for the pounds? It increases.
Yeah.
But at the same time, the price would rise from ER1 to ER2.
It will expand.
It will expand because we need more. The demand for the UK currency is increasing. So the price of the UK currency would rise from ER1 to ER2. Is it clear?
Yeah.
Now go to the question, please. Yeah, they said, which of the following factor would affect the demand for a currency? The demand for a currency.
Yeah.
What?
D.
B?
D.
D. What would affect? Yeah, it's D.
Demand for export, yeah.
I said, which of the following factor would affect the demand for? Why would countries need your currency? They need your currency because they want to buy from you. That means you are doing more of export.
Yeah.
So it is the demand for export. The second question, you have to get this right, please. Speculators can have an effect on the exchange rate. Which of the following statements about speculators is true? Speculators will only sell foreign currency.
It's D.
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 Yeah. Speculators believe that the price of currency is going to fall, they will sell that currency.
Are we sure?
Maybe it's C.
Ah, what's your answer?
I think it's D.
D. What about you, Raga?
Maybe A or D.
Or C.
No, choose one, or B, or A, everything. Choose one, please.
I don't know.
Malik. Okay. Malik. D. Okay. D. Malik choose D. I'm choosing D.
No, yes, I put this. Yeah,
It's D.
What's the
Ah, is it D?
I don't think so. Because if the currency falls, yeah, what they think it's
Why do we call them speculators?
because they only
No, why do we call them speculators? We call them speculators because they want to make investment on either a falling price or a rising price.
yes.
When it is about when we presume that prices will fall in the future, they sell now.
Yeah.
When they feel that prices is going to rise in the future, they buy more now to be able to sell to make capital gain. So the question is saying speculators can have an effect on the exchange rate. Which of the following statement about speculators is true? Speculators will only sell foreign currency, which is not. They could sell. We have what we call the bull and the bear in stock exchange. Okay. Where is it going? Okay. Speculation does not only mean in the foreign exchange. There's speculation in the stock exchange, where we have the bear and the bull. Who are the bear? The bear are those people who think that prices will fall in the future. They are quickly selling now. They sell their stock right now because they are pessimistic about the future. They have the pessimistic view that prices will fall in the future, so they sell now. We call them the bear. Those who buy now, hoping that prices will rise in the future, we call them the bull.
Yeah.
Do you understand? They are optimistic about the future, that prices will rise in the future, so they buy more now. But those that are pessimistic, they sell because of the fear that prices will fall in the future. So it is not only in the foreign exchange rate that we have speculation. We have in the commodity.
Yeah.
Everywhere in the world, in as much as there's transaction, there's buying and selling, there's speculation.
Yeah.
So that's why it's not going to be A. It's not going to be A, yes. Number two, they said B. They said speculators help to stabilize currencies. No,
They make profit because currencies are not stable.
it's not even. Are they government? They are not government. It's government that would want to stabilize price.
Yeah.
It's not about them, so it's not B. C. Speculators in foreign currency is illegal in most countries. No, it's speculation. It's allowed.
Yeah.
It's not a deal. It's allowed. I could choose to buy now. I could choose to sell now. Nobody's going to hold me.
Yeah.
So it's not C. And D. If speculators believe that the price of a currency is going to fall, they sell. If they feel that the prices is going to rise in the future, they buy. So it's about speculation. So for D, if they feel like if they believe prices is going to rise in the future, they buy more now. If they believe that prices is going to fall, they sell now.
Yeah.
So the answer is D. Clear?
Yeah.
You choose D and you're not even sure about it. How am I making you not sure? I want to be sure.
no, you make me.
I want to be sure.